Welcome back. You're still watching The Money Show right here on ET Now, and it's time to kickstart our Meet Your Fund Managers segment. And this week we have a very interesting guest lined up for you. It's Harsha Upadhayaya from Kotak AMC. Harsha, it's always a pleasure connecting with you, and thank you so much for joining us this evening. Let me first ask you about the market environment at large, because how are you advising your clients, people around you, to navigate the equity market in light of the resurfacing fears around COVID? And how would you term this volatility that we've been seeing over the last couple of days?
Clearly, the COVID fears have resurfaced in a global context. But as far as India is concerned, I think COVID fears have been abating for quite some time. There was a fear during the festive season that post-festive season, maybe because of a lot of social mingling, you would see increased number of cases. That has not happened. In fact, the number of active cases in the country today are almost 30% of the peak levels that we had seen. We had seen about 10 lakh active cases at one point of time. Today, we are at less than 3 lakh active cases. And the second spread of coronavirus has also not taken place to that extent in India. So as far as we are concerned, there is some good news on the vaccine front. The corona spread has not been as severe as what was anticipated earlier. So overall, it seems to be well under control. But at the same time, globally, there is a second or a third spike in some of the regions. So to that extent, one has to be careful in terms of how that's going to impact the markets, especially given the fact that the valuations are on the higher side, and markets have also given from the lows almost about 80% returns. So to that extent, at higher valuation levels, it is prudent to remain a little cautious. But otherwise, I really don't fear too much of COVID-related stress once again for our markets.
Okay. But what's your assessment in terms of valuations? Because that's something that I was coming to as well. Because right now there are signs of gradual economic recovery, positive news on vaccine development. In terms of valuations, where do you see potential?
I think overall, the market valuations are on the higher side. They are definitely higher than the last 10-year averages that the market has seen. But I think part of that is explainable from the fact that the cost of doing business over the last decade has come down. And also we are at the somewhat in the lower levels of economic activity. And there is an expectation that the activity levels would go back to normalcy very soon and also would grow from those levels. So given those expectations and the fact that the earnings multiple today is higher because of cost of doing business has come down, I think one can still rationalize current valuations. But as it goes higher, I think one has to be cautious. And across the board, we have seen participation. It's not that one or two pockets have become very expensive. I think one after the other. Initially, it was a lot of COVID resilient pockets of the economy, such as FMCG, IT, pharma, etc., which participated. But in the latter half of the market rally, we have also seen some of the cyclical sectors, for example, automobiles, financials, and more lately, even industrials, real estate, etc., participating in the rally. So I think broadly, the markets have moved up quite considerably from the lower levels. I think from here on, it will be more of a stock-specific moves wherever you would see valuations at reasonable levels, and also where the expected economic recovery helping them to do better numbers. So I think it has to be more a stock-specific approach in terms of portfolio construction from here on.
Let's talk about your industry specifically, because inflows through SIPs have fallen from peak levels, and the trend has been quite concerning. What trends do you foresee going into the new year? I mean, by when can we expect an incremental growth in fund flows?
Well, for the last month, we had seen record outflows from mutual funds, including erosion in SIP book. We really haven't seen any different trend in December, I would say. I think the kind of redemptions that were there in November are still continuing. We really do not know where we will end this month in terms of flows. But last month, including hybrid funds, the overall outflows from equities were in excess of 17,000 crores for the industry. So that was a very, very large number. Until then, it was roughly in the region of 4,000 to 6,000 crores of redemptions. We need to wait and see once market stabilizes at certain point of index level, whether the current level of redemptions will continue or will that also taper off. That is something that needs to be seen. And maybe in the next couple of months, we'll get a clear view in terms of how this is going to pan out.
Okay, let's talk about the Kotak Standard Multi-Cap Fund. It's the biggest multi-cap scheme that has now applied to become a flexi-cap, to come into the flexi-cap category. Except the name of the fund, should we expect any other changes in terms of investment process, fund portfolio, etc.?
We have made an application to SEBI post the November circular that allowed a new category and a new fund to be launched or converted into flexi-cap category. So using that benefit, we have approached SEBI for converting Kotak Standard Multi-Cap into flexi-cap. The decision from SEBI is still pending. Once we get a positive confirmation from SEBI, we will be converting this into a flexi-cap fund. But for an investor, it will remain the same in terms of the portfolio composition and expectation of risk, returns, etc.
And just that, the investors' expectations are in its place. What is a flexi-cap strategy? What does it bring to a fund manager's strategy or their style of investing or opportunities at large?
See, as far as flexi-cap category is concerned, as the name suggests, there won't be any restrictions in terms of where a fund manager or a fund house would invest in terms of market cap buckets. So based on our research view and our comfort in terms of relative growth and valuations, we would be free to choose any of the market capitalization buckets without any restrictions. So that's the beauty of a flexi-cap nature. And our belief is, since we were handling our multi-cap strategy similarly earlier, for an investor, there won't be any change in terms of strategy, and it will have all the flexibility that we had in the past when standard multi-cap was operating under old multi-cap rules. And the new flexi-cap rules are exactly similar to old multi-cap rules. And hence, for an investor, there won't be any difference in terms of the experience from the fund.
Okay. Could you tell us more about the rationale and behind investing in your top holdings? I'm talking about your standard multi-cap fund here. Tell us about what is the growth that you foresee in your top two bets, which is financials and IT space?
We have a judicious mix of some of the resilient pockets of the economy, which may not get really impacted because of COVID concerns. And I would put IT under that basket. And also we have exposure to some of the recovery plays, as in the cyclical pockets of the economy. And as and when the COVID fears subside and economic activity momentum continues, these would be the pockets where there would be further improvement in terms of business, as well as the valuations today are not as rich as what a peak cycle multiple would be. So that's where we have judicious mix of these sectors, and IT happens to be part of the COVID resilient pocket, I would say, and financials is part of the cyclical themes that we are playing under this fund. And as far as IT is concerned, I think the IT spends have remained quite robust. Rupee has remained stable, which also augurs well for margins. And by default, the travel costs have come down for the industry, which used to be a substantial cost. So overall, while growth has continued to remain at earlier levels or slightly better than earlier levels, given a little more spend that's happening on IT improvisation, but clearly the margins have been on the higher side, and we expect a lot of that to sustain even going forward. So overall, the profitability of the sector should continue along the current lines or may improve from the current levels. Plus, these stocks have been usually high return ratio stocks with large amounts of cash flow thrown in every year. And we also have frequent corporate actions such as buyback coming from this industry. So to that extent, it remains quite a defensive investments, I would say, given the current set of market valuations and the trends. As far as financials are concerned, we clearly believe that some of the concerns on the asset quality side that we had initially during the COVID peak is unlikely to happen. So to that extent, the provisioning levels that we have seen in the banking sector by and large should be able to take care of any of those asset quality issues. And also most banks, when I say most banks, most of the large private sector banks have raised capital during the last 6 months or so. So capital is also adequate. And whenever you see credit growth returning back along with improvement in the economy, we should start seeing at least the large private sector banks outperforming the rest of the market. So that's the thesis that we are working on as far as financials are concerned.
Okay, if we look at individual holdings, the top 10 names, 9 out of 10 of those names are large cap companies. Why have you picked a majority of chunk as large caps within the large cap basket, and would you attribute the consistent returns that your fund has generated to the prudent investment style of picking out more of blue chip companies?
We have had a very disciplined investment process, I would say. For almost last decade, we have been following this process diligently, irrespective of market phases and market volatility, which is investing about 65 to 75% in large cap stocks, because that provides stability, as you rightly mentioned. And we also like companies which are steady compounding stories, in our opinion. So we are more of a buy and hold kind of a investors rather than who try to bet on events or tactical movements. So to that extent, our portfolio is long-term oriented, and 65 to 75% large cap is something that gives stability to the portfolio, and also we carefully pick some of the compounders, in our opinion, in terms of wealth creation. Then we have rest of the money invested in predominantly mid caps and a little bit in small caps. There we look for structurally strong stories where given the strength of the company and its management, it should be in a position to really compete well within the industry and also compete with larger companies in the sector, if there are any. And those are the stories that we bet in mid and small caps. So ideally, 65 to 75% large cap and rest in mid and small caps is what we have followed over a cycle. And given the sectoral deviation that we take in the fund, we believe that this kind of asset allocation is prudent from a risk perspective, and also the investor experience is going to be a lot more comforting given stability of large caps.
Okay, well, Harsha, always great chatting with you. Thank you so much for joining us this evening on The Money Show to talk about the fund and sharing with us your views on the markets and various themes that you find value in. Slipping into another break here, coming back soon with more updates.